Welcome to the What to Watch video update. This video is where I go through the charts that I've looked at throughout the week and gone through in the daily and weekly videos, and I pick out those charts that are really saying something right now. And I have a positive side and a negative side, and they can change from one side to the other. And then we try to pick out, okay, what are we really going to watch as of right now? And the market pulled back in the past week, and we're asking the question, is this just a pullback or are we starting a decline? Now, to answer that question right off the bat, based on what we're seeing right now, it's looking like just a pullback. The 20 period moving averages, they held twice this week. So they've been tested. And so far, we're above the 20-day moving average. So we'll have to see if that can continue. We saw some strength coming in on Friday. Now, the S&P had a really solid open on Friday, but then gave all of that up and ended up closing slightly lower. But we still are seeing under the surface some strength that could be developing. And if that can continue, that could end up being positive for the market. This is being prepared for Monday, October 28th. I have a thing called the SPX Investing Program. It's free for the end of 20 until the end of 2024. Feel free to check that out if that is something that is of interest to you. There are links that will take you to the website or to a video where you can learn more. If you have any questions, you're more than welcome to email me about the program. And the daily video is really where I do my analysis and commentary. And you can't really evaluate the market by just looking at two or three different charts and doing a short analysis. It just doesn't work that way. To really understand what's going on, you really have to dive into these things. And that's why my videos are longer. That's why I do more videos. But if you watch all of the videos that I post, you have a really good handle on what's going on. And what I found over the decades of doing this is you're not caught off guard. Nothing is really surprising you because that can be the thing that catches you. When we're going up, everybody's a genius. But when things start to look a little shaky or we start to go down, people really start to question, okay, what's going on here? I need to find some answers. Well, I try to consistently give those answers and watch things as they develop. And some of the things, they don't come to fruition. We saw a nice little bounce up in Wednesday's session that could have led to a nice move up on Thursday. It didn't do that, but we were watching for that. And so when it didn't happen, it's like, okay, maybe we're not seeing the strength that we thought could have been building on Wednesday. It just didn't carry over into Thursday. And I go over those things in the daily video. And in the program that I have, there are additional videos that are shorter than these videos where you can go in and view those videos, and they're updated as close to real time as possible to get some real analysis for what's happening. Let's go through and look at some of the positive things for right now. We are still positive in the short term with our trend because the green line is above the red line. That's why we say we're positive. But we're a little bit concerned here because the ADX is below the moving average and we're declining. Now, it tried to turn up a little bit on Friday with the move that we saw, but we're still below the moving average. So this is a weakening trend. However, we use the static number of 20 to show that we're still in a trending environment, but it's weakening. However, it's a positive trend. And we see pretty much that same thing here. The chart that I focus on the most is the intermediate term, this chart right here. And we're going up with the green line, down with the red line, even though we closed slightly lower and gave back a lot of the gains on Friday. But we are in a weakening trend. However, we're in a trend because we're above 20. The same thing with the short and intermediate term. So these are confirming each other. This is actually looking a little more positive for right now, where the blue line is above the red line. This is an intraday chart of large cap growth versus large cap value, which has the most direct impact on the S&P itself. When the blue line is above the red line, that just means there's more going into growth. And now these are on different scales, but we can get kind of a picture of what's happening overall. And we saw value going down where growth actually went up, even though it came well off of its gains that it saw earlier in Friday's session. So this chart right now is looking more positive. Also, we saw a nice run up at the beginning of October we saw growth outperforming value on the intraday chart for the S&P, then a little bit of weakness, then a little bit of strength. Then we were concerned, okay, maybe things aren't looking all that good. But we saw a real improvement in Friday's session. So this is looking a little more positive as well. We want to see more follow through with this. And then the end of day chart shows that growth of value for the S&P is holding up quite well. It's not breaking out yet, but there's an uptrend here with the ratio, and we're near the previous highs. If this can keep going up, that would also be positive for the S&P. We look at a growth versus value ETF, and we had been getting concerned because we were coming down to this black line, which is a 250 period moving average. We actually broke below that back in September, but we've been able to kind of dance along this line here. Well, in Friday's session, we were able to break up out of the rainbow. So this is showing a lot of improvement as well. If we could keep going up and see the lines starting to go back up, that would also be more positive. Large cap growth, just coming off of recent all-time highs. It set an intraday high here, but not a closing high. So this is still looking quite positive. We're above all the plotted moving averages here, and the moving averages are going up. We're seeing an improvement here, but we need to see more follow through. When we look at our growth to value ratios with the Qs to S&P above the moving average, we saw a nice little bounce up here. And a lot of this had to do with Tesla's earnings that was up 22% on Thursday. That really helped this ratio, but we want to see more follow through here. And we're coming above the moving average when we compare large cap growth with large cap value. And we're looking good here with the large caps, a little bit better with the mid caps and the small caps. But on the negative side, we're still not showing an awful lot of strength with mid cap and small cap growth versus value. Discretionary, and a lot of this had to do with Tesla's earnings, looking pretty solid right now when we take the ratio between discretionary and staples. So, we can see over here that we're doing okay with discretionary by itself. It's really more of weakness that we're seeing right now in staples. That's a little bit of a warning sign, but this ratio going up is positive in and of itself. And even though we declined recently with the advanced decline line here, coming down a little bit based on price, we actually went up a little bit on Friday, even with that strong open and weaker session as we got closer to the close. These are still holding up for the most part, and we're above advancing moving averages here. So internally, the S&P is still looking pretty good. Also, when we look at the new highs minus the new lows, we're dropping off with the new highs, but we're seeing a lot of green and not much red right now. We're kind of pegged near the top when we look at our 5-day moving average here. That's why it's going sideways for the most part. We're declining a little bit with the 10-day. And that's not that we're seeing new lows there. That's a good one. It's not that we're seeing new lows expanding. It's we're seeing new highs contracting right now. And that's why this is going down. We have to look at the context here. If these moving averages, especially the 10-day is going down, why is it going down? It's not because we're seeing more new lows. It's because we're seeing a pullback in new highs. Then we have the smart money indicator, accumulation distribution, came down just a little bit, but still above an advancing moving average. The boom indicator here is saying that we're not necessarily all that far away from the moving average. So we're not getting a little overextended. So even though it declined, it's still positive. Chaikin money flow, we were kind of concerned about this. Even when the S&P was going up, the Chaikin money flow was going down. Well, we saw some improvement here, but we're kind of going flat when we look at the red line, and actually slightly declining here, but we're still positive since we're green. We want to see this actually turn and go back up to be more positive. Chaikin oscillator is declining. That's a little bit of a concern, but we're still above zero, so it's also still positive. The vortex is showing the green line going up and the red line going down, so that's also positive. And we're pulling back a little bit here, but not all that much. When you look at the cumulative advanced decline line for the S&P based on price, just coming off of setting an all-time high, pulling back a little bit here based on volume as well. And as long as we stay above the moving average here, when we look at the cumulative advanced decline line for the NYSE, yeah, it's coming down. We saw some weakness, and we saw a little bit more weakness in the broader market than what we saw in the S&P. The mega caps and semiconductors and large cap growth held up better on Friday. If we drop below this moving average, that would turn things more negative. We're also seeing a pullback with our regular NYSE advanced decline line, but for right now, we're still above an advancing moving average. Advanced decline lines. Excuse me. Seeing some weakness here, but still above the moving average, except when you look at small caps. We're starting to drop slightly below that moving average. This is the short-term moving average, and this is how I define it. It's if we're above or below the 20-day simple and exponential moving averages here. We came down to that level, tested it a couple of times. It set the low for one day, and so far we've been able to close above that. Now, if we break below that and close below it, that'll turn the short-term trend negative. But for right now, we're still above these moving averages. This is a short-term rainbow, but longer in its view. We go from 10 periods up to 50 periods. Boy, excuse me with the voice here. And I had a long day teaching, and my voice gets really raw when I do a lot of English lessons. We are pulling back, and we're coming into the top end of the rainbow, but the lines are still going up for the most part. And as long as we stay above that 20-day moving average, we'll still remain positive here. Then we are still above all the plotted moving averages, the 20, the 50s, the 100s, and the 200s, and all the lines continue to go up. So on a trending basis, we're still positive there. We're still positive with the parabolic SAR as long as the dots remain underneath. This is another indicator that I developed decades ago. It's a 20-period simple moving average of the open, high, low, close. We're coming down, and sometimes one of these lines will end up providing support, and we develop a little mini rainbow here. And we've been staying at the upper end of this mini rainbow for right now. So this is still looking positive, and the lines are still continuing to go up. NASDAQ 100, it's kind of hard to see. You got a whole gobbledygook mess of numbers over here, but still doing okay for the time being. And where the S&P gave back a lot of its gains on Friday, the NASDAQ 100 gave up gains, but still ended up closing more positive. This is encouraging too. This is the QQQs, which is the ETF for the NASDAQ 100. We were able to get back above this 20-period moving average and stay above it. Now, it is a little nerve-wracking that we opened really high and closed near the low, but we're still above this short-term moving average, and the lines continue to go up. Total U.S. stock ETF setting a recent all-time high, seeing a little bit of weakness now, but still above its 50-day moving average. And we look at a ratio between the Qs and the small caps, we're still right around this blue level here. We didn't hit it and then reverse and go down like we did back in the dot-com bust. And the perma bears are just sure we were going to get up to this level, turn and burn to the downside. No, we're just kind of hanging around these current high levels, and this is positive. The FANG index is still above its 50-day moving average. It still has a ways to go to get back to the July 16th high that is set here, but it's still looking positive. And there are a couple of trend lines here. We have a short-term trend line, which we're still below. We have a longer-term trend line here, which we're still above. We're right in between that. So for right now, support is holding, but we do have some overhead resistance potentially here. And then this measures what the market thinks, kind of in a proxy way of, do they think we're going to have a soft landing or a hard landing? Still voting more towards the soft landing, meaning that we will not go into a recession. And all of these lines continue to go up as stocks continue to outperform bonds. This is an inverse of that same chart, showing how bonds are underperforming stocks. As this keeps going down, that's more positive for the S&P. And we look at a broad market measure, the S&P 1500, pulling back a little bit, but still above the rainbow when we compare it to short-term bonds. Then we look at another broad market measure with 3 to 7 year bonds, pulling back, but still above the rainbow. The tech sector up outside of the rainbow when we compare it to 3 to 7 year bonds. The QQQs also looking good when we compare it to 3 to 7 year bonds. And this is positive, and this kind of goes against your logic here. When this is going down, that's actually positive for the S&P. That means that the S&P is outperforming staples, and staples are more defensive. Toilet paper, toothpaste. And that's what folks get into when they're worried about the market declining, because that tends to hold up better when the market's under pressure. Well, for the most part, we've been declining. We've been chopping around over the last few sessions, but when you look at this in a little bit longer view here, we have been declining, and that's more positive for the S&P. This is a weekly chart of the S&P 500. We're well above this R2 level here, and still all of the weekly bars are looking pretty positive. And as I point out, we did have the decline back last spring. We had the decline over the summer. But when you look at all of this together, it's still looking pretty solid. The NASDAQ 100 still above this long-term trend line going back to 2009. We look at another ratio from the NASDAQ 100 to the Dow. The Dow's just coming off setting all-time highs a week ago, but we're still getting a very high reading, meaning the NASDAQ is still holding up quite well when compared to the Dow. The reason why this would go down is this would mean that tech is going out of favor, and the Dow, which are considered the bluest of the blue chips or the best stocks there are, that means folks are getting more defensive and they're going out of the growth or areas and getting into more the quality areas. Not to say that the growth areas aren't quality, but that's usually what we see from this. And we saw a real decline back in 2000. We came up right to this same reading before at the end of 2021. Well, now we've been hanging out above this ratio level right now and actually going back up. This could be stronger, but it's not falling apart. Semiconductors had a pretty good day on Friday, and we look at a semiconductor to Dow ratio. Again, growth versus more safety. We would like this to go further back up to the blue line, but the fact that it's not really falling apart is positive in and of itself. Now we look at some negative things. Now we're still positive when we look at sentiment, but look at the context. We hit that 75 level and now we're starting to come down. So when we're going down, we tend to go with that and treat sentiment now as more negative until proven otherwise. We're dropping negative in the short term with the advanced decline ratio. That's based on 19 periods. The blue line here is actually dropped below zero. The red line is still positive, but it is also declining, and that's based on 39 periods. We're getting up above 20 again with the VIX. And when we get up to that level, that's when we see negative annualized returns for the VIX. So we want to be aware of that. But the momentum of the VIX still continues to be down as measured by the MACD. Now, if we start to go back up, and you can see the MACD is trying to turn here, if we cross above the moving average, that would be more negative, meaning stocks are probably going down. We look at the common stock on the NYSE, seeing some weakness here after setting an all-time high, and also based on volume, seeing a little bit of weakness here. Not necessarily falling apart, but since we're going down, that tends to be more negative, of course. We're getting extreme negative with the McClellan oscillator for the S&P. We're dropping below this level here. If we can get down here, bottom at some point, and then start to go back up, that would be more positive. But for right now, we're looking extreme and quite negative. And when the McClellan oscillator is negative, that means that we're declining with the summation index based on price. We're also declining based on volume. And this is a primary indicator, and this is why we're getting some mixed signals currently. The McClellan oscillator for the NYSE also declining and below zero, so it's negative, but not extreme. So we're going down with the summation index on the NYSE based on price and volume. The Swenlin trading oscillator has turned negative, dropping below zero based on price and volume. That's a bit of a concern. This is not a primary indicator, in my opinion. It's kind of right in between a primary and secondary indicator. We are turning a little more negative when we look at momentum. We're pretty much sideways now with our short-term oscillator, the slope, but we're starting to turn down with our other short-term oscillator, the TSI, where in the intermediate term, the MACD, the PMO, and PPO are now crossing below their moving averages, rolling over a bit with our long-term oscillator, the TRIX, but still right on top of the moving average with the KST. But overall, this is shifting more negative. And even though we're getting a very high reading with the bullish percent index, we are coming down. And so that is negative in and of itself. We're also declining after getting a very high reading with the NYSE bullish percent index, also declining, but still positive since we're above 50 with the NASDAQ 100 bullish percent index. And for the most part, we've been going down with this ratio. It's more positive when we look at S&P to utilities and take a ratio of that. We want this to go up. And for the most part, it's been going down. We're dropping below 50 with those stocks inside the S&P above their 20 period moving averages. Now the S&P is still above its 20 period moving average, but now we're seeing fewer stocks above their 20-day moving averages as well. And then we're looking a little more negative here with the study that we look at since we're going down. We're declining, but still positive with those stocks above their 50-day moving average. Also declining with the 100 period moving average study and the 200 period moving average study. So even though the 50, 100, and 200 are still positive, the context is that they've been going down. We're going negative here with the NASDAQ 100 momentum as measured by the PPO, where we're crossing below the moving average. And small caps, you can almost call this before it happened. We come up to a high range and then give it back. Come up to a high range, give it back. Just really choppy. Well, it looks like small caps were doing well. Now they've actually dropped below their 50-day moving average. Now this is the SML. This is the S&P 600 small cap index. If we go to the next chart, we're still above the 50-day moving average when we look at the Russell 2000 small cap index, but still looking more negative. We're dropping below 50 with the RSI, and the momentum is negative as measured by the MACD. And we look at the small cap to S&P 500 ratio, still in a pretty solid downtrend. Small caps still have a lot to do to start to outperform the S&P 500, and these are more negative with the small cap growth of value. Now, S&P growth of value, it's holding up better. But when we look at small cap growth of value, not doing all that well, even though it ticked up a bit on Friday. It's still in a downtrend. Mid caps just setting an all-time high a week ago in a downtrend when we look at the mid cap growth versus mid cap value, even though it improved a bit on Friday. The staples to tech ratio, I put this on the negative side mainly because of the moving averages. We just saw a recent golden cross here. Now we're dropping down, and that's positive for tech. That means tech is outperforming. But we need to see this cross back over and give a death cross to turn this chart more negative, which means staples are underperforming tech. And to say it another way, tech would be outperforming staples. And we've been concerned about the rise in the 10-year yield. We got up above the 4.25 level, and it looked like, okay, maybe interest rates were coming down. Well, in Friday's session, we came down, we hit the 200-day moving average, and then really shot up after that. And that's when stocks started to see some sell-offs happening. And we're a little more negative here. It's still positive in the bigger picture, but the home construction, the 3 to 7 year bonds coming down into the rainbow, where most of the time it's been riding up above the rainbow. And these are just things here that we're just watching out for. Weekly jobless claims. They will come out on Thursday. We saw a real big bump up in the previous week, a real decline in the latest reading here, but the moving average is still going up. And that would mean the employment situation is showing some weakness. We also want to keep an eye on this. This will be updated on Thursday as well, where the continuing claims beyond 1 week, they are continuing to go up, and that might suggest some economic or employment situation weakness. Now, we're going to get the employment situation report on Friday, and that's going to be really big. And we'll see how that report fits into the context of what we're seeing here. We are concerned that we continue to consistently be well below average with volume. And we're looking at this, trying to figure out the context of what is happening here. When you look at pretty much cash, 1 to 3 month T-bills, and compare it with 3 to 7 year bonds, when this is going up like it was back in 2022, that's because there was uncertainty about interest rates. The Fed was in raising rates at that point, and inflation was still going up. Well, then we've been kind of bouncing around all over the place, and we started to come down as inflation was more under control, but now we're starting to go back up again. Well, inflation doesn't seem to really be a problem. Is it interest rates going back up? Is that causing a bit of a concern here? But historically, we're going back up to a higher range of where interest rates are usually at. We don't usually have such a low range like we did after the great financial crisis in 2008. So we're trying to watch this as it's unfolding and just see, okay, what context can we take away from this? It would be more positive if this was continuing to decline. And we are seeing a little more confidence here. When we look at TIPS, Treasury inflation protected securities, when there are inflation worries and interest rates are going up, people get into TIPS and they outperform. When inflation seems to be under control, that's when we see this ratio going down. Well, it had been really going back up, and we were like, okay, why is this happening? But now it's starting to come back down again, but we could be getting ready to see a golden cross with this ratio. And this looks a little further out. This is tips to 7 to 10 years. This was 3 to 7 years. Then we go to 7 to 10 years. This is also continuing to go up, and we're watching this to see, are we just gravitating towards a higher interest rate environment, and that's historically what has happened, or is there something under the surface that we're waiting to see develop? But for right now, this tends to be more negative, but the market really hasn't been paying attention to that too much. We are keeping an eye on oil, mainly for geopolitical reasons. I'm recording this over the weekend, and there were strikes where Israel did actually attack Iran. There's also speculation that this is just the first wave, and there will be more after this. So we'll have to see, is Iran going to do anything? They control the Strait of Hormuz there, where a lot of oil goes back and forth. Is that really going to bump up the price of oil? And if oil goes up for that reason, is that going to put some pressure on stocks? And the dollar's been really strong lately, and the stocks tend to like a weaker dollar. It's really been going back up, even though it's still in a downtrend, but looking pretty solid currently. And then we have this Hindenburg Omen. I stopped showing this in the daily video because there really hasn't been an update. And if you watched this video a week ago, we just have time that's been added to the chart. Really, nothing else has changed. We've seen a confirmation now. We had the initial spike and then the confirmation spike. We want to pay attention to this. This could take a period of time to work out, if it even develops into anything at all. But because we saw a series of spikes right before the whole COVID crash, and we saw another series of spikes that took a little bit of time to work out right at the end of 2021. And then that ended up going into 2022, which was a very challenging year. So we just want to be aware of this for the time being. Thank you. I really hope you found this helpful. I hope you have a wonderful weekend, and I will talk to you in the next video.